Hi guys, my name is Azizov. I am CEO of B2 Broker Group of Companies. And here today we are together with John Murillo. John is Head of Dealing Division of B2 Broker Group of Companies. You know, we received question from our clients, and actually the same questions we have been receiving since day one of operations, not only from our client, but also from sales team, from our leads, from account managers. And John, I would like to elaborate on this question. The question basically is about leverage. What kind of leverage? For example, if we say I'm running brokerage business and I wanna be very attractive in terms of leverage, because you know leverage is one of the key component of trading, and leverage impact on my margin requirements, and eventually it makes impact on the amount that I can invest or like use as an initial deposit in order to be able to start trading and to make some money. And so please explain how it works, how actually you as a liquidity provider, what kind of leverage, maximum leverage you can give me, minimum size, who is behind you, how much leverage do they provide to you, and me as a broker, what can I do with this?
Arthur, that's actually a very good question, commonly asked by most of our customers. And one must be very objective on this topic. Let's start from how this whole liquidity is constructed. When you have banks, tier one banks, they typically price into a PB, and that PB effectively is where margin takes place. Margin requirements are applied to retail space. It's basically a series of credit facilitation that is done between the PB and the prime of prime, which is us. Now, B2 Broker, what it does is we take those conditions that the PB passes on to us, and as an institutional offer, we deliver those conditions to our customers. We're not a brokerage. We run purely an SCP model. And with this in mind, we basically pass those conditions, and effectively you as a business, you will decide what conditions you wish to pass on to your customer. Now, let's take the prime of prime model of ours as B2 Broker. We don't use our balance sheet. We pass on those conditions straight to a brokerage, and the brokerage will decide based on their risk tolerance and balance sheet as well, how to manage their clientele. So the margin requirement on our end, or the leverage that you pass on to your end user, will be dictated primarily by your balance sheet, by your funding capability. I'll give you an example. If you come to us as B2 Broker and we are margined by our PB at 1%, it's more or less 1 to 100 leverage. That's the fee we pass on to you, and you pay to enter a trade. Let's say one lot of your dollar. When you go to your end user as a retail end user, you will decide the amount of margin requirement you wish to receive from him. If you wish to pass on the exact same conditions as ours, then you will basically give him leverage of 1 to 100. But the question here is 1 to 500. Do we offer that? And the answer would be no. Why? Because that will make me a broker. And we are an institutional service. Therefore, what I receive is what I pass on to you.
I see. But okay, and if we are talking about prime brokerage, what is the leverage there? Because as I know, actually banks, they leverage maybe just 10% or sometimes even 50%. So can you elaborate on this?
Yeah, definitely. The more institutional we get, the higher the margin requirements are. I'll give you an example. If you have a PB the PB is going to margin approximately on majors anywhere between 3 to 5%.
3 to 5%.
We as Beach Broker, we pass on to you a fee that is passed on to us. Now, bear in mind that we have multiple clients, so the margin requirement for an institution of our size is X, and we pass on that to the end user, being the ultimate broker dealer or whatever business it is that is serving us.
And also, besides of that, John, we are running institutional liquidity provision business. We have to keep in mind also net open position side that prime brokers and other non-banking participants allow us to keep with them, because net open position, that's the parameter that also makes impact
on the margin.
Right?
Absolutely. And this is a very debatable topic nowadays in era. There's a misperception out there. Of course, everybody wants more business, but when you have substantial operations, when you have significant amount of flow, when those trades are being offsetted against the PB, they are on a net basis. So it's a net open position that creates the margin requirement needs for an institution. Now, the margin requirement, Arthur, this is very important, varies from majors to crosses to exotic pairs, to metals, to almost everything that we are margin on. So it's not a one size or one amount fixed for all. There's statistical analysis carried out in the back scenes by the banks, which will assess the margin requirement. I'll give you an example. Recently, margins have increased in the PB world anywhere between 7.5% to 10% on gold, just to give you an idea. And obviously, margins go up and they also decrease. Another case we have in recent times is our new margin requirements on crypto. Crypto majors, for example, are now decreased to just 10% margin requirements.
Because they became a bit more liquid, more participants appeared on the market, and more flexibility.
Exactly. That's the dynamic of margin. But to the end user, to that business that is taking our liquidity, what we do here is we pass on those conditions we are receiving to you in order to encourage the best trading conditions.
I see, makes sense. Okay, but this part is clear about institutional size is clear, and it's clear that then more efficient market such as Forex, CFD, then this market more established, let's say, then margin requirements is less. If we take into consideration crypto market, as there are no many PBs as on the Forex market, not many prime brokers, liquidity providers, market makers, and this is why exchanges are offering big leverage. Basically, they're trying to do also internalization and take some risk on their side, because it's the retail flow. But they have also, they keep in mind every time that they give you very high leverage until or up to certain amount of open position. That's why they also keep their approach based on net open position.
That's a very interesting topic, because people have the way, to some degree, I call it the predetermined approach. And if you have a big position, that's one thing. But when you have a very large position in our industry, there are typically thresholds that liquidity providers may apply to you. For example, if you build a position of 10,000 lots on Aussie dollar, on Euro dollar, on one of the majors, prime brokers will margin you in a certain way. if you end up with a position very large, they may increase your margin requirements. So this is a tricky bit of the industry. We as a business, we have such a mix of different operations. We have a very, very flexible margin, I will call approach, because through time we know more or less our clients' needs. In that profile, we convey this to our liquidity providers, and through our PB, we create solutions that fit all types of businesses.
I see. Yeah, makes sense. And this part is clear about institutional, about efficiency of the, let's say, well-developed market, and just as a crypto market, because it's still under development. Now I see on the crypto market there are a lot of, let's say, weaknesses or inefficiencies.
Yes.
But through time they will be covered. And the good thing is that technology from the Forex market, this technology it's moving to the crypto market, and eventually it's gonna become one united market, maybe, or maybe just, but technology, it's for sure it's replaceable technology from Forex to crypto, from crypto to Forex. So both industries, they are getting close, definitely.
And that is a fact. I remember 20 plus years ago when the Forex market was not as developed as it is today. I see over the last 2-3 years a major shift in what I consider an evolution in the crypto space, CFD primarily. So yes, the technologies are merging, and I think the CFD business, the FX business, tech is helping the crypto CFD world to evolve much quicker than FX was 20 plus years ago.
And what is your leverage now on crypto CFD pairs? Well, and how you do basically crypto CFD? And why? What is the difference between crypto CFD, crypto perpetuals, and crypto spot? I'm a broker, so I wanna launch on my brokerage some kind of crypto trading products, and I don't know what to choose. Can you please help me with this?
Yeah, definitely. So we have in our specifications a very detailed description of our requirements. But just to give you an example, on crypto majors at present, our margin requirement is only 10%. If we go back in time, just 2.5-3 years ago, margin requirements used to be 50%. Imagine in such a short period of time how we are closing the gap. And think of it this way: on FX, we charge 1%. The way I see crypto, I think one day, despite the volatility in the market, through maturity, we will see lower and lower margin requirements. The rest of the crypto pairs, we apply 20%. Crypto CFD is where the true liquidity lies at this moment in time in our industry. But of course, as you know, we offer different crypto products, derivatives. We have the spot and perpetuals. Perpetuals is a very exciting project, I consider. It's a very interesting topic to discuss in greater depth, but as well, the crypto spot business remains one of our strong points in our solution.
Okay, so this part is clear, and as far as I understood, it's good to offer like crypto CFD on my MT4, MT5, but on MT4 I know there is the problem with offering crypto CFD due to the decimals. Precision, yes. Like so, and it's a big problem basically, but on MT5 there's no such problem, and I can easily offer 100, 200. Like I can take all your crypto CFD liquidity pool and just to stream to my clients, right? It's
plug and play solution. For example, we can get you up and running in 5 minutes. It is very much developed and tested through time. Just to give you an example, all of our customers, over 168 active customers at the moment, are using our crypto CFD liquidity.
Cool, impressive. And okay, last question here on these terms. How should I manage my leverage for my clients? For example, I'm taking from you Forex liquidity with 1% margin, which is more or less 1-to-100 leverage, right?
Correct.
For major crypto CFDs, you are offering me 10% margin, right? So it's
Correct.
more or less 1-to-10 leverage. So how I supposed to manage this in order to provide to my customers, to my end users, 1-to-200, 500, maybe for very small clients even up to 1,000. Especially, for example, I have a license in Belarus, and license in Belarus, they allow me to go up to 500 leverage. So how I supposed to manage? And from your 100, make it 500.
So it's a topic that every broker constantly comes to us for advice. What we tell everyone is the following. You must assess the risk of your clients based on your balance sheet needs. Typically, businesses at the beginning, they fully hedge the position, they pass on the trade to us, and you offset risk. Leverage they provide to the client has a tendency of being more conservative. So of course, you have to go to market with a competitive product. Typically, what the broker does is the small accounts uses higher leverage, and the bigger accounts, which are bigger capital, needs to be more or less in line with the institutional business.
So actually the same approach with NOP, net open position.
Most definitely.
So no matter if let's say if you have 1 million deposit, but you used in the market just $1,000, no problem, you can take leverage 500.
And the key, Arthur, to the success of an operation with us in the liquidity space, be well capitalized. You, at the beginning of a business, need to focus on growing the business, not taking risk or managing risk. Let that job be, pass on, offset, and focus on growing your operation. That's the true secret. And then you assess the type of leverage you can provide to your clients once you have enough client base.
I see. And also, as far as I understand, if you have then more clients you can do netting. So for example, 10 clients with the leverage 1-to-500, they placed orders, I don't know, they are selling, they are shorting, let's say, Euro USD. Another 10 clients, they are buying. And despite the fact that they have 500 leverage, on the margin account, they will have
zero margin
margin, right? So
exactly.
That's the also impact that one of the key point here for the brokers to expand their database.
Exactly.
And in order to have as many, then more clients they have, then simple, then easy for them to make a netting of all these positions from the clients.
And that's the secret of brokerage. More customers, less margin requirement ultimately, because you're always going to have buyers and sellers in your operation. Netting is the key. The same way apply to you. We look at your positions, you buy and sell with us. We look at the net open position, and based on that, you will be margin on a currency basis.
So guys, just to conclude, as you just heard our conversation, there are several approaches how to manage leverage to your end users, to your customers. So now you know how prime brokers, how they provide leverage to prime of prime or liquidity providers, and how liquidity providers, how they use different approach, how to give this margin to you. And now you know how you can provide bigger leverage to your end users based on net open position approach and also based on the netting approach. So here's no exact clear answer, can you provide or not? Of course you can, but we have to wait every time risk and your ability to manage that. So this is why I guess this video will be very helpful to you, and let's keep in touch. Thank you.